So our next speaker is Stefan Grbenic from the Technical University in Graz, Austria. He will talk about carbon risk and firm value. Now, Dr. Professor Stefan Grbenic is assistant professor at the Institute of Business Economics and Industrial Sociology at Graz University of Technology. He is head of the working group Management Control, Accounting and Finance. Furthermore, he is guest or visiting professor at the University of Maribor, University of Twente, and Istanbul Medeniyet University as well. Mr. Grbenic is tax consultant, certified valuation analyst, EACVA and NACVA, and expert witness. Thank you.
Sorry, I had to introduce my voice here. So hello out there from Austria. I hope you can hear me.
Yes.
Yes, very good. Thank you for the reply. So I'm talking about carbon risk and value of the firm. So I have a number of slides on models and modeling and on research results, and I thought I will start with something different. I will start with a song from Austrian actors and singers from the No Air, No Art project. So the No Air, No Art project is an art project that tries to sensibilize people for the environment and attempts to make our world a little greener. And so I thought I will spend two and a half minutes of our time. And to show you this video, I'm allowed to do this. I just have to calibrate my computer and the Zoom that you can directly listen to the video, and afterwards we recalibrate immediately, and then we continue with the slides. Okay. I just have some help because we usually work in WebEx and not in Zoom, so it's not so easy for us here. Yes. So, jetzt geht euch. So, hello again. So, okay, I hope, can you hear me now? We just recalibrated.
Yes, yes, we can hear you.
Yes, okay. So I hope you enjoyed it. Thank you to my colleague for helping. Okay, the topic is carbon risk and firm value, a core piece in the eco-efficiency premium puzzle. So what I attempt is to give you just some insights in the research here. I'm a finance guy, so it's some insights in finance research. Before I start, I just have to say thank you for inviting me to this conference, and I hope I can add some valuable information to this. Okay, so the agenda would be just let's talk about the concept of eco-efficiency and the first step, then in the second step, carbon performance and investment performance. So the question behind this is, does it pay off to invest in firms that act in an environmental favorable manner? Because if this is the case, automatically the money will go there, investments will go there. And if this is not the case, the money will not automatically go there. Okay, so this is the research on that. So if it's not, it would be not the case, then politics would have to change the circumstances for that. But let's see what the research tells us if it pays off to invest into green companies. Then in the third part, let's talk about carbon exposure of European utilities. So let's go one step ahead into valuation. So carbon risk, carbon exposure of European utilities, because in utilities, of course, they are very sensible to carbon, and the research usually focuses on this utility sector. In the fourth part, let's talk about some of my personal research, of our research at our university, of carbon exposure of European firms in an augmented multi-factor framework. So just make it a little more complicated, the research. And maybe if we find the time, let's see, then I would have an add-on. So chapter 5, it's carbon risk, cost of debt, and the moderating effect of media attention. So if you have media attention, positive or negative, does this affect risk of a company, and in the next step, the value of the company? Okay, so let's start with the concept of eco-efficiency. What is it? The economic value a company creates relative to the waste it generates by creating that value. This is what in finance we understand under the concept of eco-efficiency. So the meta underlying research question is, does socially responsible investing, so the SRI, lead to superior or to inferior portfolio performance? If it leads to superior portfolio performance, then the money will go there. If it leads to inferior portfolio performance, the money will not automatically go there. Okay, so just one sidestep for a minute is our traditional models, finance models, assume that it cannot lead to superior portfolio performance, because all our models, or the widely known and used models, say it's all about risk and return. And if you diversify your investment at best, so if you maximize diversification of your investment, you can reduce risk to a minimum and automatically increase or maximize a return. So there is no space for any other things in our traditional models. So, but the question is, of course, they are all models and we know that they are not the truth at all. So is there any space for other things like socially responsible investing? So this is the meta research question behind all this research. And for example, like Lakonishok et al. Or Hogan and Baker, even in the 1990s, they say it depends on the financial market's ability to factor the financial consequences of corporate social responsibility into stock prices. It depends on the ability of the market if it has an impact or not. And I try, let's go through this research and let's see what we found out and what we do not know so far. So the widespread belief is, so the opponents of social responsibility investment is at the investment level, incorporating ethical criteria into investment decision comes at the expense of portfolio performance. So this is the world, the model world. There's only risk and return. There is no space for anything else. Okay, so it comes at the expense of portfolio performance. So the money would not automatically go to social responsibility investments, socially responsible investments. Okay, so the question is just, is this true? Reasoning suggests that socially responsible investors who would be inherently suffering from imposed limits to diversification should report suboptimal returns. So this is the same. Asset pricing literature relying on the efficient market hypothesis, this is what we rely on in our models, posits that investment portfolios deliver returns proportional to associated risk. So it's just the risk and return game and nothing else. The optimal investment portfolio is a well-diversified one, therefore any empirical evidence of anomalous risk-adjusted investment performance on the part of stocks grouped by company characteristics such as size, book-to-market ratio, or even corporate social responsibility are attributable to deficiencies in the performance evaluation models that attempt to explain them. Okay, so this is also, they say there is no space for anything else than risk and return, and if there is any space, then it's a problem of the models. Okay, the proponents of social responsible investments, they argue that the corporate social responsibility reflects the company manager's view on how the company will perform in the long run. So it's not the short run thinking anymore, they say. In the short run, of course, it's risk and reward and return, but on the long run, there is something more. And these views may be mispriced in the market because investors usually have short run horizons. Okay, so this is what the proponents say. And in this trade-off in between, let's see what research tells us. We have different streams of research on this environmental financial relationship. Three categories according to Wagner. It's the first group is the portfolio studies. What is done in these studies, they compose mutually exclusive portfolios based on various corporate social performance indicators and investigate the portfolio's return differences over some investment horizons. So they form portfolios of environmental responsible companies and environmental not so responsible companies, and have a look if there are any differences. And yes, there are some differences. For example, some researchers found that they produce the social responsible companies produce a higher Sharpe ratio. Sharpe ratio is a performance measure in portfolio returns, or a positive Jensen's alpha. We will talk about this Jensen's alpha in a minute. So we also found that they have a higher positive Jensen's alpha. So according to the portfolio studies we know so far, it pays off to invest into green companies. The second type of studies are event studies. So any event that leads to any abnormal thing in the returns. So abnormal declines in stock prices 2 days prior to their pollution figures being reported. Shane and Spicer found this even in the 1980s. And so abnormal declines or increases depends on if pollution figures were reported. So the market reacts on this. Or negative returns are significantly larger for companies with relatively poor records of pollution control. So the event is, again, the records of pollution and control and so on, and the rankings are published, and then the return of the stocks reacts on this. Or positive corporate events measured by environmental awards given to companies are associated with positive subsequent abnormal returns. So they get a reward and then the stock price reacts to this. Okay, so this is a typical idea of event studies. And the third group is multivariate regression or correlation studies, so some statistics. For example, companies in the US pulp and paper industry with the better pollution control records have a higher profitability, so higher stock returns accompanied by lower stock betas. And the beta is in finance the risk measure, okay, so lower risk. Okay, so this was found in the US, but on the other hand, we found no evidence, or some researchers like Ziegler, Rennings, and Schröder, or Thomas in beginning of the 2000s found no evidence that pollution control initiatives are rewarded with improved stock performance. So we have no clear research on that. The conclusion of these inconsistent results is that, of course, and I also think this, that the differences are mainly attributable to differences in methodology and in the choice of financial and environmental performance indicators, and not so much on the basic ideas and the basic results, but it's more a methodological problem on this. Okay, so this is why we tried to improve our measures. And nowadays we have, I think, personally think, a relatively good and robust measure, the so-called InnoVest measure, as I just mentioned it here. It consists of around 60 categories of sub-measures. It's composed of 60 categories, capturing things like physical risks by the direct impacts of climate change, or regulatory compliance risks, or value chain emissions profiles, as we just heard before, or policy and government capabilities, business risks, and all things like this. So over 60 criteria. And so this is the measure nowadays often used. So let's have a look at one analysis, I think an interesting analysis of Derwal, Günster, Bauer, and Kodijk in 2005. So it's a little older, but it still holds nowadays. So the research question they followed was, do the high-ranked InnoVest measure portfolios provide substantially higher average returns than its low-ranked counterpart? So it's a typical portfolio study. And if this is the case, then the money will go there. Investors will invest into these companies. If it's not the case, investors will not invest automatically there. Okay, so the data was from 1995 to 2003, and the high-ranked portfolio consists of the companies making up the 30% of total capitalization rated highest, lowest by this InnoVest measure. And the proxy for the market, because we always need a proxy in our measurements, is the CRISP database. So this is a very powerful American database on company data. And the basic finding was portfolio consisting of highly eco-efficient companies, so having a high InnoVest measure, performed better, meaning that they provided substantially higher average returns than the portfolio consisting of eco-inefficient companies. So, and they measured it by the result that they had a lower Sharpe ratio than the market, the low InnoVest measure companies. So they were even lower than the average market. So this is a good sign also in this research. Okay, so just some thoughts on the model. So it's the typical CAPM, a one-factor model used in the research. So it means that we have the return on the portfolio I in month T. So we measure in month sequences to avoid thin trading bias, minus the risk-free interest rate. So we have the opportunity to get a return without taking any risk. This is the risk-free interest rate. And then it's a normal univariate regression. So we have the intercept and the beta, the risk measure, multiplied by the market risk premium. This is the return of the market, the CRISP, all CRISP companies in this case, minus the risk-free interest rate and the error term. And they did it without, so excluding industry effects and also including industry effects. So you might see the difference is this IP and the related beta risk coefficients. So these are three components capturing industry effects. And the result, as you can see, the alpha, the intercept, this is no risk, how much return. And you see the high-ranked companies and the low-ranked companies. High-ranked companies have a positive alpha of 1.29%. So it means that you can get, if you invest into high-ranked, according to this Innovest measure, high-ranked companies, you can earn money without taking any risk. Whereas in the low-ranked companies, you cannot earn any money because it's minus. The alpha is negative. The intercept is negative. You cannot earn. And the difference portfolios, so as we always do, we do difference portfolios. You see it's around 3% difference. And if you adjust for the industries, it's even close to 4%. So this is a very good sign. It pays off to invest in environmental sensitive companies. So this alpha is, there is a standing axiom, it's everybody's hunting for a high alpha. So this is what we look for in investment theory and also in practicals in investment. Everybody's hunting for a high alpha. If you find an investment without any risk giving you a high return, of course you will give your money there. And if you have an investment giving you no return or even a negative return, bearing no risk, of course you will not invest there. Okay. So everybody's hunting for this high alpha, and we see the high-ranked companies, according to the Innovest measure, give us a high alpha. So this is a very good sign for the green companies. And this is what also is written in the sentences done. And this was the primary result for this. If we extend this simple CAPM one-factor model into the multi-factor framework, so Pharma French is a typical model for this. So we have the same here. This is again the CAPN world, including the error term. And then we introduce some more factors in our model. So we think that risk does not explain all variances in stock returns. So for example, a size effect. We say that small and large companies behave differently according to investment theory, and so the size effect is a return difference between a small cap portfolio and a large cap portfolio, for example. Or we have the same with HML, value versus growth companies, according to the book value to market value ratio, this HML, and the momentum effect, the return difference between a portfolio of past 12 months winners and a portfolio of past 12 months losers. Okay, so we introduce three more factors. So in total, this is then a fourth, the very well-known finance four-factor model. And let's do this again. Let's do our test. Well, they did the test again, introducing this multi-factor model, and they did it excluding industry effects and again including industry effects. You have this IP here again, these three factors capturing industry effects, and the results again show that the high-ranked companies have a positive alpha. Everybody's hunting for a high alpha. So a very good sign, even statistically significant at the 10% level. And the low-ranked companies again have a negative alpha. So difference portfolio is 5%, now it's even a little higher, and industry adjusted 6%. So again, it pays off to invest into green or social responsible investment companies. Okay, so it pays off to invest into green companies. Let's do it this way, even in the four-factor model world and the more developed world. Okay, so some results. Also, the R-square, the adjusted R-square increases, and we saw that the S&P, HML, and the momentum factors, they are significant, at least at the 10% level in some times. So it makes sense to use, as we know from finance research, not the standard CAPM model, but they got the Nobel Prize for this CAPM model, and some type of this CAPM model. So it's better to employ the four-factor model, but it still holds that investing into green companies pays off. So the money should automatically or will automatically go there. But as we will see, only to a special group of green companies because they made a robustness test, a robustness analysis, and they formed portfolios not just good performing and bad performing according to this Innovest measure, but they formed portfolios the 20% best and the 40% best and worst companies. And you say the 20%, you see, as you can see, the 20% best even have an alpha of 8.60%, whereas the 40% portfolios have less than if you divide it into two halves. So it turns out that only the really good performing ones are a good green investment. It's not all better performing companies are a good green investment. It's especially the very good performing ones, so the 20% best. Okay, we have to find them. And there to invest pays off, so the money would go there. So you have, as a company, the other way around, you have to perform really well to attract the investors. Okay, you also see in the sensitive sectors only the difference is a little lower than before. So it's really just, if you do really good, then you're a good investment for the investors. Okay, so performance gap widened a little and also fell for the 20% for the portfolios for the best ones, and it fell a little for the 40% portfolios. So it's again, only the really good performers are good investments. Okay, so this is a main, this is why I thought I will present you this slide. So it's not everybody doing green is a good investment, only the really good ones. And this slide tells us that it's independent from investment style, industry bias, and market sensitivity and things like this. So this holds quite stable for different models and even different data and different circumstances. Okay, so some ideas on the concept of eco-efficiency. I just have a look at time. I think I have around 10 more minutes. Is this right?
Yeah, you can take 10 or 15 minutes. Yeah.
Okay, so 10 to 15 minutes. Okay, very good. Thank you. So step 2, carbon performance and investment performance. So just some slides and some data on if you're doing good in carbon, it's also the investment performance good. We would expect yes, but we will see one interesting thing in this. So we have just some slides. So global results, companies positioned in the top carbon performance. That's about concerning carbon. We are talking here. It's have a higher expected return in comparison to the overall market, as well as vis-a-vis same sector competitors. So we have above average rating according to this Innovest measure. So this green measure or this social investment responsibility investment measure, and the below ones are the blue ones. And you see that the total returns on the y-axis on the ordinate is higher than, so are above, perform better than the below average rating companies and are the global results. So also from this point of view, it pays off to invest in green companies. We have the same on a regional breakdown. For North America, we see that the gap is, it's not that clear, but there is some gap coming up now that the above average rated, Innovest rated companies perform better. In Europe, the gap is a little stronger, a little bigger. And the interesting thing is that in Asia Pacific, it's the opposite graph. Without any more comments, but you see the above average rated companies, so they invest in green energies and green and things like this, perform worse than the ones who do not do it. Up to now, at least, up to 2017, at least. But it has not changed too much in the past. So there are regional differences at the moment. Okay, and if we add a sector-specific perspective, we see the utility sector is very strongly hit by this carbon thinkings and green thing. Of course, we have a big difference in the material sector. The difference also the above average rated companies perform better according to the total return of the stock returns but the difference is not so big. But in the utility sector, the difference is really big. This is also why we love to employ the utility sector when measuring things like this, because if there is a difference, you see a very quite big difference. Okay, so I think especially if you turn back on this Asia Pacific difference is maybe a little interesting at the moment. Okay, some data. Let's go to the risk, because the title is carbon risk and firm value. So one important factor of firm value, of course, is risk. The other two ones are growth and profitability, at least these three one according to finance theory. So let's talk about carbon exposure. So carbon risk of European utilities. As I mentioned, we love to measure these things in utilities companies because we see big differences. So carbon exposure environmental risks refer to the actual or potential adverse effects on organisms and the environment of waste discharge and resource consumption resulting from business activities. So this is an overall definition of this. And as an integral component of our environmental risk, carbon risk mainly refers to the impact of climate change caused by CO2 emissions. So we focus on carbon risks because it's quite easy to measure these things because we have stock price information on these carbon factors. So carbon risk typically consists of three components: so the regulatory risk, physical risk, and business risk. And also the before mentioned InnoVest measure also knows this. And I said around 60, a little more than 60 criteria they take into account. And they also stem from regulatory risk, physical risk, and business risk. And different studies focus on different types of risks sometimes. Sometimes they focus on the overall risk and some focus on several types of risk. So I present you the analysis of Koch and Bassen of 2013, carbon exposure of European utilities, and they determined so the determination of the effect of carbon price risks on the cost of capital and related to this on firm value. So cost of capital is an investment is equal in, or a company creates value, because in the presentation before and the question was, does something create value? It creates value if it creates a better result than the cost of capital. If the return is higher than the cost of capital according to finance, then you create value. And if it costs more, so it costs less, or the return is higher than the cost of capital. If the return is lower than the cost of capital, you destroy value and you should not invest into this, or you should not do whatever you do. You should not do this. Okay, so this is the connection. And of course, the cost of capital, an important factor is risk, because cost of capital, cost of equity, and cost of debt capital. And for both, but especially for the cost of equity capital, for the investors giving you the equity, risk, the beta, the so-called very well-known beta factor, is very important to assess the cost of this capital. So this is the link in this research, and determine the firm effect, cost of capital effect of carbon risks, and the second stage simulate equity values by explicitly controlling for these carbon risks. So the hypothesis, the starting point was that the price of carbon is an additional source of risk. And long-term investment decisions are exposed to a carbon price risk. And if this holds, then we can create the hypothesis one: carbon risks do not affect the firm's specific cost of capital. But this was their hypothesis one, but it does not affect the firm specific cost of capital. Hypothesis two was high emitting utilities bear carbon risk premiums caused by a higher cost of capital. And three, low emitting utilities benefit from a carbon risk discount. And we have the related research on this slide, so that they come from stating this hypothesis. So just have a short look at the model and then at the results. So they again had this one factor CAPM model. So you see maybe here again, the beta and the return of a market minus risk-free interest rate, the error term. And then we introduce in this research a carbon beta, this carbon risk. Again, with the return of some carbon stocks. And we introduce some controlling variables, so energy variables. Okay, and if you just keep in mind this red field, we translate this because it's easy to measure. Translate these energy factors into oil, gas, coal, and electricity, because we have stock prices or market prices for this type of energy. So we introduce this here, and the results then are, I have a blue line on my slide. Does anybody know what? Okay, so the expectation is insignificant carbon betas would be consistent with hypothesis 1, and if hypothesis 2 holds, the identified high emitting utilities should exhibit significant positive carbon betas, and if hypothesis 3 holds, we expect a priori negative carbon betas for firms operating low emitting power parks. Okay. Yes, this is where the data comes from. MSCI Europe was the market, and you see the commodity price information for Brent crude oil from independent commodity information services, and so this is why we can use this in this data. Sorry, in our research, because we have prices for this. As you can see, the carbon price, there is a carbon beta. Yeah, for the high emitting companies, even statistically significant. For the low emitting ones, not, but there is a carbon beta, so that means carbon beta can explain or is part of the risk in the models. That should not be according to literature, but the models are not complete, and so there is space for this, or at least we measure. At the moment we can measure this, and especially for the high emitting companies. So higher emitting companies have a higher risk, carbon risk. Okay, so this is the main result we see here. Then again, let's do a multi-factor model. So you see the S&P, HML, and the momentum factor. And they also introduced a term premium, so risk-free term discount rates, or something very special in this research. And again, we see that in the CAPM model and in this 4-factor model, we have some impact of oil, coal, and gas on the returns, but of course the other components explain a lot more. So we see there is some explanatory power of coal, especially coal prices, but it's not too much. So it does not explain too much. This was the target of this research. And finally, why I showed you this is they also made a sectoral analysis, and you see across different sectors the results change a little. So some sectors are sensitive to this oil, coal, and gas prices, and in other sectors the sensitivity is almost nothing. So usually you have to view different sectors behave differently according to a risk, to this carbon risk, are differently sensitive to carbon risk. Okay, so results of this sectoral and the general conclusions we had. Last step, because I think for the 5th chapter we will not find the time, but I can in advance I can say, of course, if you have a positive media attention, this has an impact on carbon risk. This was the result of this paper I would have presented in this chapter 5. And so, but only if you have a positive media attention, then you can reduce the risk. Yeah, if you have a negative media attention, it does not automatically mean that you increase your risk. But if you have a positive, you can reduce the risk. But let's turn to chapter 4. Just this is one of my research, just make it a little more complicated in a so-called 5-factor model. This is the most valuable model. So the idea on the data, it's some other data, it's the OBIS database in this case. And this was the model. And what is new? It's the CMA. So the investment factor difference of portfolios of stocks of low conservative and high aggressive investment firms. So this is the one more factor. So included in this model. So oil, gas, coal, and electricity data is the same as before. And on the other way around, this term premium. I did not use this term premium. Instead, I used from this 5-factor framework, the CMA. And the results you see again, the last slide, I think, we have a carbon beta. So carbon emissions are part of risk. And even I have a time breakdown in here. So see, it changes over different time periods, but it's existing all the time and even statistically significant. So to close up in here, let's finish with this slide. So investing into green companies, this is a good sign for us, I think, pays off. It reduces risk and it increases portfolio values, and it also is able to decrease the cost of debt financing, and with this it increases firm value. So companies are, at the moment, from the point of view, good in investing into green energy and things like this, and try to be to have a good balance on carbon, because investors, it pays off for investors to invest their money there. So just the last slide here, because I need the final slide to say thank you for your attention. I hope you enjoyed it.
Okay, thank you very much for your presentation. Now, if again anyone would like to ask any questions.
Can I have a comment?
Yes.
Because I know there is a question, but this is something completely different. I believe, wait a second. I believe that you just answered my previous question on how to promote the role of bioeconomy. Your unorthodox beginning of your presentation is showing how to promote bioeconomy to younger population. That was my comment. So I don't have questions. Thank you, Stefan.
Yes, so I hope you enjoyed this video. Yeah, so it was just, I thought I'd do something different because we have so many slides in here, and I thought maybe it's a nice idea. Hopefully it was.
Could you please perhaps refer us to some specific tools for measuring the carbon footprint of small and medium enterprises in Serbia? Like, what would be first steps of an enterprise to calculate their footprint as a first step towards the carbon risk assessment?
Sorry, I did not get exactly because I had some problems in the connection. So could you pose a question again?
I asked you if you could perhaps refer us to some specific tools or first steps for medium and small enterprise owners to make first steps towards the calculating their carbon footprint in order to.
Okay, so what I tried to address in this research was that it pays off the capital market, of course, because this is all capital market data we employ here. It pays off for companies to do green, to improve, let's say, in your words, to improve the carbon footprint. Let's say it like this, because at the moment it pays off for investors. Okay. So this is, we have a better portfolio performance for those who do well in this. So if maybe, we don't know, but maybe this also holds for smaller companies, not listed on the capital market, because as I said again, this is all for capital market data research. The second thing is to increase the value, and of course, if as a company you increase value, you get more attractive for investors. Not investing on the capital market, of course. And if you reduce your risk, of course, if you reduce risk, so if you reduce your beta, then you reduce your discount rate and you increase value with this. If you think about the discounted cash flow models, yeah, if you reduce beta, you reduce the discount rate, and with this you increase a value of the company. But what to do exactly for a company as a first step is not the idea of this research I presented here. I cannot now directly tell you. A good idea is everything for an SME, everything that reduces your risk. Of course, we know this from finance theory, increases your firm value or your company value. You say, okay, so I cannot tell you now direct or ultimate steps for an SME now here.
Okay, thank you. Sorry.
No, sorry for that. that I'm not the right one for telling you for an SME how to improve your carbon footprint. I'm just a finance guy who says, let's see if we can measure it, if it's a good idea. So this is
okay. Thank you very much.